Today, let's dive into a story that is, well, it's a bit of a cautionary tale. It's about a guy named Vod, a brand new trader whose journey pretty much shows us every single destructive trap in the market. You know, the kind of traps that anybody, and I mean anybody, can fall into.
And this is where it all begins, with a statement just dripping in that classic ironic overconfidence. See, Vade feels totally prepared. He's armed with all this knowledge from YouTube University, and he's ready to take on the market. This right here is probably the most dangerous stage for any new trader.
So, let's meet Ved. He kicks off his trading career on a Monday, not with some carefully crafted strategy, but with just pure, unfiltered excitement. Let's see how his very first day goes.
Okay, so the market opens with a huge bang. The index gaps up. And what's Ved's first thought? Wow, it's already going up. Look at that momentum. I gotta buy. And so he does. He jumps in right at the very top, driven by nothing more than the fear of missing out. He's not analyzing a thing, he's just chasing green.
And this is where the mental gymnastics begin. The price pulls back, but he doesn't see a mistake. Oh no, he sees a discount. His thinking goes from, hey, I got a dip, it's cheaper now, to, this is just a shakeout by the big operators. As he casually removes his stop loss, he's literally rewriting the rules in his head to justify a bad call.
So, what was the result of day one? Well, you can probably guess. A total disaster. By just ignoring every rule in the book and trading on pure emotion, Vade starts his career with a pretty significant loss. But believe me, this is just the beginning of a pattern. You'd think that first day's disaster would slow him down, right? Nope. Instead, it kicks off a whole week of bad habits. Basically, a masterclass in exactly what not to do. So on day two, Ved decides, okay, I need a strategy. So he goes online, finds 4 of them, and then tries to use all of them at the same time. We're talking opening range breakouts, support and resistance, moving average crossovers, and RSI divergence. Just a chaotic mess of signals that are probably telling him to do opposite things.
And just how chaotic was it? By lunchtime, he had already placed 17 trades. 17! This wasn't a strategy. This was just frantic button clicking. The only person who was happy about this was probably his broker. Ved was just exhausted, and again, the result was a disaster.
Day 3, Ved sort of evolves. Now he's a predictor. He sees some news that the banking sector is looking bullish, and he immediately buys a bank stock. The problem? He buys it right at a major resistance level. You know, that spot on the chart where sellers have been hanging out forever. The price rejects almost instantly. And here we see the sunk cost fallacy play out in real time. What started as a simple intraday trade, which should have been a small, quick loss, starts to completely unravel. He just can't accept he made a mistake, so he holds it overnight. Now it's a swing trade. When it gaps down the next morning, he makes that final, fatal decision. He relabels it a long-term investment.
All right, it's day 4. Now Ved is just hurt, and he wants his money back. Welcome to the revenge trading phase. Logic? Thrown out the window. His brilliant new plan is to just double his position size, so he can win his losses back faster. This really shows you the warped psychology of his trading. It's a powerful bias called loss aversion. So when a trade shows even a tiny little profit, he panics and exits immediately, terrified of losing it. But when a trade shows a loss, he suddenly becomes the world's biggest optimist, just holding and hoping for a turnaround. He's cutting his winners short and letting his losers run wild.
And here's the brutal math behind that mindset. His average winning trade is a tiny 500 rupees. His average losing trade, a staggering 18,000 rupees. Think about that. It would take him 36 winning trades just to cover one single loss. This is basically a guaranteed formula for blowing up an account.
So by the end of the week, Friday, Ved makes one last big pivot. He decides the problem isn't him, it's his tools. So what does he do? He loads up his chart with 9 different indicators, turning it into something that honestly looks more like an ECG monitor from a hospital. The result is just pure analysis paralysis. By the time all 9 of his indicators finally line up, the move he was waiting for is already over.
So that first week was all about bad tactics. But the weeks that followed, that was about something much, much deeper. It was about a complete psychological collapse, where emotion just takes the driver's seat entirely.
In week 2, every single rule is just gone. He's glued to his profit and loss screen, checking it every 20 seconds. He's jumping out of good trades because he's scared, holding on to bad ones because of hope, and he's constantly moving his targets and stops around in the middle of a trade. He's not trading based on a plan anymore. He's just trading because he's bored or angry or just because the market is open.
Then in week 3, his recovery plan just makes everything so much worse. He adds up his total loss and decides he can win it all back in just 3 good trades. And how's he going to do that? By increasing his position size by 5 times. The result is predictable. 3 massive new losses, which just fuels this vicious cycle of desperation.
And by week 4, he hits the final stage. A perfect textbook setup appears right on his chart. Everything he's learned is telling him to go for it. But now, he's just paralyzed by fear. He hesitates, he watches the entire move happen without him, and then, completely consumed by FOMO, he jumps in at the very top, just in time for it to reverse on him.
So at the end of the month, Vade looks at his statement, and he comes to a conclusion. But his diagnosis, it's not the real one. Let's break down what was really going on here.
So what's Ved's final takeaway from all this? The market is manipulated. A small retail trader just can't win. It's a classic defense mechanism, right? Instead of looking in the mirror at his own actions, he blames some invisible external force. It's the market's fault, not his.
So this really is the million-dollar question. Was it a rigged market, or was there something else entirely going on? Let's get to the real diagnosis. The reality is, Ved never lost because of a bad strategy or a manipulated market. He lost because he was trying to predict the market instead of just reacting to what it was doing. He increased his position size when what he really needed was to increase his patience. He did everything he could to avoid small, manageable losses, which led directly to catastrophic ones. And ultimately, he was chasing the emotional comfort of being right, not the financial reality of being profitable.
And that, right there, brings us to the core lesson of this whole story. The charts, the news, the indicators, all of that was just background noise. Vid wasn't actually trading the market. He was trading his own feelings, his excitement, his greed, his fear, and his hope. And really, that's the question we should all be asking ourselves, and not just in trading, but in any high-stakes decision. The story of Ved is this powerful reminder that the biggest opponent we face isn't out there in the market. It's right here, inside our own heads. So are you reacting to what's actually happening, or just to how you feel about it?